So you can just keep an eye on the gold price and just multiply by 2. So we should be today, we should be around $80. In other words, so which is almost the inflation adjusted. Well, gold is well past its all-time high. So silver hasn't even broken its inflation adjusted. Gold has. So silver should be around 2%, and it's going to go there. I think it's going to go 2.5 to 3. So I think silver's going somewhere. Depending on what gold does, you can just do the math. It's really easy. If we go to $6,000 gold, which I think we will, so 1% 60, 2% 120. So I think we're going north of $100 silver, and there's a very good chance we'll go north of 150. And if we do that, the silver miners are going to be unbelievably lucrative, if you will.
Analysts Don Durrett and John Feneck emphasize a simple yet powerful framework for valuing silver. Track the gold price and multiply it by a factor of 2. Historically, silver has lagged behind gold in major bull markets. However, this lag often gives way to explosive catch-up rallies. Today, gold has already broken well past its inflation-adjusted highs, while silver hasn't even approached its equivalent level. If gold climbs towards $6,000 an ounce, a proportional move would place silver comfortably above $100, and potentially even near $150. Such a breakout would ignite enormous upside in the silver mining sector, where leverage to the metal's price is the greatest. Both analysts agree, Nate. Silver remains one of the most asymmetric opportunities in the commodities space, combining scarcity, industrial demand, and monetary relevance in one trade. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Yeah, so what John said, we had that consolidation in gold. So it consolidated right around 3,300 this summer, and we had like a 3-month consolidation there. And all the fundamentals for gold have been strong and I think improving all the time. And so it wasn't going to break down. So when you consolidate, you're either going to break down or break up at some point. I mean, you can go sideways for a long time, but it looked like eventually it was going to break up, and it did. And it really ripped. I mean, so it went up, and we had this, and silver joined the party during that breakout in August. You had the breakout in August, and silver went above 40 and kind of joined the party for the first time. And then the miners kind of went nuts, and we had a kind of a change point in August. I actually think that August was the beginning. You say, is this over? The very, very beginning of this, what we've been waiting for, this bull market breakout. And so, yeah, it ran too hard, too fast. It went from 3,300 to almost 4,400. That was in 2 months. That was a bit of too fast. But it showed you how much demand there is for gold, and that it's not going away. And now we're having. It could only run so far, and now we're having a bit of a correction, consolidation here around 4,000. And I think it'll in November. I'm actually bullish here. I actually think that the stock market, because November historically is one of the best months of the year for stocks, and coming out of October, so we haven't had a 5% correction since April of 24. So the stock market, it ripped through September, October with no problems. So if the stock market was going to have a 5% correction, it probably would have been in September or October. So here we go to September. Well, gold has been correlated with the S&P since, for quite a while now. And so whenever gold has went down, it is, and the S&P has stayed up, gold has turned around and went back up. So I think that gold will have a bit of a bounce here in November. That's my expectation. In other words, this correction, 10% correction in gold, I think is over here in the short term. And this was kind of wave number 1. So if you think about it, people that have been in the miners for a while now, they should be up 100%. GDXJ is up over 100% in the last year alone, and up 200% in the last over 2+ years. So you should be up 100%, and this is leg 1. And so leg 2, so we're consolidating. Leg 2 is actually, I think, going to be probably the most kind of the juiciest part of this whole thing, because when we go to leg 2, that's when we win, basically. That's when everybody comes into this market. And that's so we double again. So we doubled here, and now the next leg up is number 2. We double again. It's going to be the juiciest. It's going to be the easiest. I mean, you could say leg 1 was the easiest, but I think leg 2 will be even easier, because that's when the money comes in from the stock market, that's when you get the rotation into this play. So far, this first move is all early money. So it's all early birds coming in. So the next move, I think, is going to be kind of even easier. The next double. That's when it's like the beginning of the mania kind of phase. And the third leg is the mania phase. That's when you get 80% in, it even happens even faster. But I believe we have two more legs to go in this. So this is leg one, made that 100%. Now we're correcting. And now we're waiting for the stock market to roll over. The gold miners, they do well when the stock market does poorly. Well, guess where the stock market is right now? It's at an all-time high, and yet we're up over 100% on our portfolios. That's what I mean. So it's like, whoa, what's happening here? You need to look at the drivers of gold, and the drivers of gold, which, that's a 20-minute conversation. The drivers of gold are improving. They're not decreasing. They're getting better. But one other final point I want to make here is that I really believe that silver will outperform gold. So right now, silver is about 1% of gold. So you take $4,000 gold times one, you get 40. You do it times two, you get 80. And so we're a little over 1%. I think we're going to 2 easy. We're going to go somewhere. I think we're going to go around 2.5 to 3.5. So you can just keep an eye on the gold price and just multiply by 2. So we should be around $80. In other words, which is almost the inflation adjusted. Well, gold is well past its all-time high. So silver hasn't even broken its inflation adjusted. Gold has. So silver should be around 2%, and it's going to go there. I think it's going to go 2.5 to 3. So I think silver's going somewhere. Depending on what gold does, you can just do the math. It's really easy. If we go to $6,000 gold, which I think we will, so 1% 60, 2% is 120. So I think we're going north of $100 silver, and there's a very good chance we'll go north of 150. And if we do that, the silver miners are going to be unbelievably lucrative, if you will. So I think we're down here at $48 silver. Believe it or not, this is really cheap. Believe it or not, it's still cheap. We until silver gets to $75 silver, until it gets there, we're still in this early innings kind of thing. But once we get to 75, the silver miners are going to be ripping. That's when I said that second phase is kicking into gear, with the easy phase, the easy money phase.
Dondurrett explains that gold's long-awaited consolidation around $3,300 this summer set the stage for a decisive breakout, marking the start of what he believes is an accurate bull market in precious metals. The August surge to nearly $4,400 confirmed growing demand, followed by a healthy correction and stabilization near $4,000. The pause before the next major leg higher. Both he and John Feneck view this as leg one of a 3-stage bull cycle, where leg two, the next phase, could be the most profitable as mainstream money begins to shift from stocks to metals. Silver, they argue, remains deeply undervalued, with potential to outperform gold dramatically as momentum builds. Let's get into the interview.
Just inflation for silver, it's actually below 70. I haven't looked, it's not 100. 2011, if you go back to 1980, it's like 135, I think. But so I've done it several times. So it's right around 69, 70. Now, as far as silver, it's definitely more speculative than gold. Gold is kind of, it's very little of it is used in fabrication. It's usually mostly investment in jewelry, and most of your jewelry is kind of investment as well. Most of the jewelry is bought in India for, investment purposes. So gold is, a much safer, easier play, if you will. Silver, there's lots of variables, very highly volatile. But I like it a lot in that I'm a speculator. It gives me a ton of leverage. All the silver miners right now are still cheap, which is kind of crazy because we've doubled, our portfolios have doubled, and yet these silver miners are still very cheap, which is crazy. That you can still get in, buy these miners at these levels. Now, as far as upside goes, I don't think there's enough 1,000-ounce bars out there for both investors and fabricators. The fabricators need about 70% of supply, or somewhere around there. So they have about 1 billion ounces. So they need about 700 million ounces. Once the investors can overrun that very quickly. As a matter of fact, they have overrun it for the last 3 or 4 years. Last year, they overran it by over 100 million ounces, meaning that we had a deficit of over 100 million ounces. That was all investor money. So you basically, demand exceeded supply production supply, so we had to use inventory supply. That's what they call the deficit. Last year it was over 100 million ounces. The last 3 or 4 years has been over 100. I think it even approached 200. But we're having these deficits, and so the investors are already overrunning supply. And so those 1,000 ounce bars, they weigh about 70 pounds. Those bars are what we create everything from. Silver jewelry to 10-ounce bars to 100-ounce bars. Everything's created from the 1,000-ounce bars. So the 1,000-ounce bars, they're on those. You see them on those big pallets. That inventory is crucial for the whole silver sector. If you run out of 1,000-ounce bars, silver's going to the moon really, really fast. And I think we will run out of 1,000-ounce bars. As a matter of fact, in October, LBMA had an inventory problem. Now it's been rectified. We had a big backwardation. People were talking about LBMA in London having inventory issues. So we're already starting to have it. I don't think that's going away. In my book, when I wrote my book in 2010, I said you can expect to have a shortage in these 1,000-ounce bars. And so once that happens, you're going to run out of 10-ounce, 5-ounce, 10-ounce, and 100-ounce bars on the internet very, very quickly. We call the term unobtainium. It's like, I want a 10-ounce bar, and go find it. You won't be able to find it because once the inventory is out, if there's no 1,000-ounce bars to create new bars, then that's the problem. So I think shortages are inevitable. I could be wrong, but that's my hunch, is that we go into phase two. I mentioned we're kind of in this is the first round, the first cycle. Now we've had this first correction number one. And I think the HUI went up to almost 650, I think. The next one, I think, is going to go to 1,000. That'll be kind of cycle two. And then the last one, the HUI will double again from 1,000 to 2,000. And so if you did that, if you go up, you go up 100%, you go once. If you double again, you have a 300% return. You double again, you have a 700% return. So that's my target. My target is 700% return. If we get the HUI somewhere between 1,800 and 1,000, then I'll get there. And so people are still early. I mean, big returns are still available here, but you can keep an eye on silver inventories.
According to Dondurrett, silver remains one of the most compelling yet misunderstood opportunities in the metals market. Despite doubling in price alongside gold, the sector is still deeply undervalued, especially the silver miners, which he describes as cheap beyond reason. Structural deficits have persisted for years, with global investors consuming more than annual production, forcing inventories to cover the shortfall. The critical issue lies in the supply of 1,000-ounce bars, which serve as the foundation for all fabricated silver products. Once those reserves are depleted, physical shortages could accelerate prices dramatically, creating what he calls unobtainium. Durrett sees this as phase two of a powerful multi-year bull cycle, with the HUI index potentially climbing toward 1,000 and beyond. The rewards, he believes, are just beginning for those positioned early. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.